Hello. So today I would actually be giving a Q1 summary, talking about the AIA Pro Achiever as well as what it takes to actually buy a second property. And I'm sure this is something that is very common on everyone's mind. With the current market, a lot of people have been talking about, oh, it's very high rental, I should buy another property. But what are some of the disadvantages or the advantages that comes with it? All right, so let's just dive in. For the market summary today, just generally across 2022, all asset classes actually underperformed negatively. This was something that was very prevalent in whether you're in equities or bonds or whether you're in any form of region, because the truth was that the Ukraine war really affected global worldwide, and everyone was actually still trying to recover from the COVID blues, right? Most of the suffering actually happened in the first half of last year, which everybody was actually trying to recover in the second half, but it actually also still is pretty slow as of right now. So you can see for those who actually bought Mercer policies, which is under Wealth Pro Advantage, most of you guys will actually have bought $250 per month for 25 years, including myself. And we actually buy it as form of a long-term savings for ourselves. And when you actually can see how for the Mercer portfolio that it was pretty decent from inception. It's actually about 13.1, especially for those who, or in fact, most of you guys who have actually bought Pro Adventurous. Yeah, it's just that last year was actually pretty bad, so it was only 4.6%. Okay. So just generally across global economic was that the inflation actually remains to be a long concern this year. Inflation was actually, or rather supply chain was very badly hit, where a lot of the fuel, a lot of the gas, a lot of the core resources in Russia and in European were deadlocked. So because of that, there was a shoot up in terms of things such as we see like sugar, oil, rice, everything. We see a huge increase. And of course, everybody was also suffering in terms of their daily living. Okay. And we actually are worrying of more tightening ahead. So that's actually the truth is that this year would actually not be an easy ride, because for the sharp increase in inflation last year would actually requires quite a fair bit of time in order to ride it out. Okay. Increases in inflation can actually significantly reduce portfolio returns in real time. Returns in real terms. So especially, sometimes it does take a really long while in order for some of the effects to die out. But if that actually happens, one thing that we will have to bear and be okay with is that there will be a reduce in portfolio returns. If it's anything, must understand that you are not the only one going through it, and it's actually a global phenomenon. So where do we go from here is that whether you are in equities or bonds, they actually did poorly. The equities actually had for Fed hikes, and for the inflation actually led to a sell-off in the bonds. So where do we go from here is that last year we already saw the high to low to high decelerating times already. So right now we're actually seeing still high, although it's actually decelerating and cooling off. Yeah, so portfolios often lack the tools to actually manage through an inflation cycle. That is the very reason why we actually need um uh, very well managed professionals to actually help us with it. In which that's where we actually have Mercer to help us on a quarter or annual basis. Usually they do annual, but for those who are actually buying into elite funds, which is AIA Pro Achiever, they actually get to do the adjustment on a monthly basis. And the kind of economy that everybody's looking at is for China, because say for 2022 it's only 2.7, but starting from 2023 to 2024, you are gonna expect like a double in terms of the GDP estimates. So to 5.1 and 5.2, you would also see that for those who actually buy into emerging market, Asia, ex-Japan, Greater China, we're actually going to have a little bit of a slight overweight. So they would actually buy more of the and increase the percentage in there. Okay, so you can see that reflected in our Pro Adventurers, Pro Optimizer as well. Global REITs, there was a decrease, of course, but there's an increase in terms of global equities, because we decide to actually, instead of keeping it to Asia X region, why not diversify the risk to global equities instead. Singapore equity also increased in order to actually stabilize out. Although equities is actually was still suffering, but Singapore being pretty stable, that's why we actually chose to increase the percentage instead. Okay, so Portfolio Pro Adventurers, again, for those people who bought into our Mercer policies, you actually can see there's an increase in global equities, Singapore equities, decrease in global REITs and emerging market equity. Okay, at the end of the day, this portfolio is actually designed for investors who are willing to accept significant short-term fluctuations. We actually offer cautious from a range of less risky, which is cautious balance, to the more risky ones like optimizer and adventurous. Okay, so what are the differences between elite funds and guided portfolios? So we actually have two types. One is actually called AIA guided portfolio, which is by Mercer, and the other one is by AIA Investment Management, Capital Group, Wellington Management, Bailey Gifford, and BlackRock. So this is Pro Achiever, right? Pro Achiever. And what is actually so unique about it is that it's actually only exclusive for AIA policy holders. Being managed under for AIA policyholders also mean that you cannot buy off the shelf from any other companies, which is very different from the guided portfolios, which are from Schroders, Fidelity, PineBridge, Franklin Templeton, which can be found in financial institutions in Singapore. So the elite funds are very unique to Singapore, very unique to AIA insurance customers that we are only offering to them. Should they actually decide to want to try a bit of investment, but they don't want to do it themselves. And right now, in fact, it's actually a good time to buy because the market is actually recovering. It's still on a low, and we actually can only look to it as it will only recover in due time to come. So if you actually buy now, then that's when you actually get it at low prices. So if you actually look at Elite Adventurous Fund, since inception about 3 years ago, it did 6.15 to 6.7, which is very decent for a fund. However, of course, because of last year where everybody was in the red, -12, -8, for the benchmark, and then that is why if you put it out, across 3 years, then that's when you bring it up to 6.15 to 6.57. Okay, of course, the other one would be a balanced fund and the conservative fund. So this AIA Pro Achiever 3.0 actually is really affordable. Starts from $200 per month. If you're actually having extra money sitting in the bank, not knowing what to do with it, okay, and you're actually looking to have a medium term savings, then this would be a good option. In fact, I actually stopped selling savings or endowment unless it's because of their risk appetite, like they absolutely are very risk averse, or they actually are looking to get even education fund, like for my son, I also bought a Pro Achiever. Okay, so you actually have a choice of 10, 15, or 20 years lock-in period, and you don't have to pay anything thereafter. It is up to 800. Okay. So if that is the case, it means that you don't have to work. After you pay finish your time 15 or 20, you actually can leave the interest to continue to increase and increase all the way until you decide to surrender, or if you actually decide to take out a policy loan, which so far I actually do see quite a handful of clients. No, actually only currently I did have one client who actually reached into the loan function of the policy in order to pay for the renovation. So the other thing that I'd like to talk about, the last one, would actually be about second property. Okay, right now I decided to actually include some information here because I realized that a lot of clients are actually looking to, they're having excess cash, decide to invest in a second property. Okay, but what are the advantages or the disadvantages? First would actually be if you buy into the property right now, everything is all expensive, so that's the truth. Although you can get high rental income, but you also pay a lot more elsewhere. Later on, I'll share with you. However, when it comes to buying investment policies, there is no such charges. You just pay for the supplementary charges, otherwise there's no other charges. Yeah, there is a lot of law policies to go through, such as decoupling, and otherwise ABSD will be incurred, but no such thing for insurance policies. Okay. And for second property is there's always an ongoing effort to find tenants. Sometimes people realize that the money that the tenants pay actually goes to a lot of maintenance. Condo maintenance, rental income is taxed perpetually, and they actually cost money to renovate property periodically. Okay. But under insurance policy is really simple. You just need to pay whatever that you have been paying fixed. And after first 10 years, then there will be actually no other perpetual charges. And of course, second property always feels good. There's a feel good factor in collecting passive rental income. However, the rental income, like what I mentioned, it has to go into offsetting the monthly loan repayment and ongoing costs. Okay. And with every investment, housing price appreciation and rental yield is not guaranteed. Unlike insurance policy, which is also not guaranteed, but we actually can protect and cut to cover our risk by actually buying into low risk investment portfolios. So assuming the couple have actually done a decoupling on the first property, for the second property, they're actually looking at these costs. Supposing that the house costs $1 million, there is an option money that you have to pay, which is 5%, 50K. Legal fees, 3K. The loan amount, 750K. And then looking at a 25 years loan tenure, you're actually paying 4% per annum. You're actually looking to paying about 4K. Supposing that you actually end up taking in a rental income about 5K, you only have about 1K extra to pay everything else, such as fire insurance, condo conservancy, and rental income is also taxed. However, should you actually decide to buy into APA, there is no such cost. APA 3.0, there's a total cash outlay 250K. Annual premium is 25K. And then of course there's welcome bonus, which means that for every year you decide to put in, the AIA actually tops up extra, which is one of the benefits for APA 3.0, because we would like to encourage people to purchase long term. And after the 11th year, there'll be no other charges, no withdrawal charges, no surrender charges, no whatsoever. So you actually can do any form of changes to it after the 10th year. Okay. All right. So this is a very short and simple one for everybody. And I hope this has been pretty useful in keeping you guys updated about what's going on in the market.